Welcome to ForexTV.com. It's Friday, February 29th. I'm Remy Hokie for New York Forex Market Buzz. In afternoon trade as of 1:20 Eastern Time, Euro dollar is at 1:51.82. Sterling dollar is trading at 1:98.65, while dollar yen is at 104.20. U.S. equities are deep in the red, with the major indexes down over 1.5% on the day. Earlier today, the Commerce Department reported that consumer spending climbed more than expected, up 0.4% in January. Core PCE was up 0.3%. Following the 0.2% gain in December, and January spending increased 0.4% after the 0.3% climb in the previous month. Meanwhile, Chicago PMI plunged, falling to 44.5 in February from 51.5 in the previous month. And last but not least, in U.S. data releases, the U of Mich Consumer Sentiment Index came in at 70.8 from 78.4 in January, hitting a 16-year low. This afternoon, I'm joined by Rhonda Staskow from Thomson Financial. Good afternoon, Rhonda.
Good afternoon.
Thank you for joining us ahead of the weekend. Well, first and foremost, the U.S. dollar has pulled back from earlier session lows against the euro, cable, and yen, but dollar-yen has had quite a morning, with the pair falling below 104 and nearing the 103.80 level. Given the significant move we've seen today, and also since we've had Fed speakers this afternoon, if you could weigh in on the near-term fundamental and technical outlook for dollar-yen.
Well, quite frankly, I mean, the mood remains substantially bearish, not least of which is that many in the market believe that the yen has not really caught up with the moves we've seen in the euro and the Swiss over this week, particularly with euro reaching record highs. And I think you saw part of that with the capitulation trade last night, with risk aversion rising on the back of the fall of the Nikkei and, of course, the continued falls in stocks today. But also exporters starting to panic now that dollar-yen is below 105, and month-end flow is also pressuring dollar-yen. Now, there's supposed to be new investment fund launches next week in Japan, but there's been talk that the subscriptions are lower than expected because of the concerns of the current market volatility across the world, as well as the ongoing credit woes. And so that's going to keep dollar-yen under pressure. And for some time, the target has been for dollar-yen to go down to 100. And typically, for Japanese investors, when risk aversion becomes high and the economy starts to slow at home, which we're starting to see, you tend to see them bring their money home. So the risk still is much lower, with more option targets at 103.50 and 103, and likely to go to 100 in coming sessions, particularly ahead of the fiscal year end in Japan at the end of March, which will also add to dollar-yen selling.
And this week we have been seeing broad U.S. dollar weakness, with record lows for the U.S. currency against the euro and Swissy. But ahead of the weekend, if we could first start out with your forecast for euro dollar as well as sterling dollar.
Well, I wouldn't be surprised, at least with the euro, to see the currency try and head up a little bit higher once again and go above the recent highs we've seen, and possibly try and test 153. I wouldn't rule that out, just because of the preponderance of bad economic data that we're getting out of the U.S. that continues to give the market an excuse to sell. And the market's not completely convinced of a European slowdown, despite indicators such as Italian and Spanish sentiment that's just come out, showing that the bites we've seen on the economy here in the U.S. is starting to have an impact. That being said, two things could temper further weakness. One is the preponderance of central bank meetings next week that will have the market squaring up ahead of those meetings, particularly the ECB. Also because we have the U.S. jobs numbers, which are expected to be bad, but will also prompt some profit taking. And the last thing I'd like to point out is that the Fed custody holdings show that central banks have been accumulating dollars at a massive rate, $85 billion since the start of the year, that has sent Fed custody to new record highs. So central banks are counting on a turn in the dollar despite all the bad news, which is really interesting. And if the market looks at that, that could help stem the current euro gains.
Well, Rhonda, now that we've covered euro dollar and sterling dollar, let's move on to the dollar block currencies. We've seen plenty of volatility this week in the markets, and commodities have been soaring in recent sessions, with the CRB index hitting records. So looking at the dollar block currencies of the Aussie, Kiwi, as well as the CAD, if you could give us your brief fundamental outlook for the currencies against the dollar and yen.
Oh, for those currencies, I think we may have found a near-term top for a number of reasons. One is the renewed risk aversion. Two, the focus, particularly for Aussie and Kiwi, about funding costs. A lot of traders are pointing out that Australian banks are now having problems with funding and looking at spreads they've paid in the last week and a half on the international market for funding and showing that the U.S. credit crunch is moving over to Australia. And they expect the banks there to start raising rates more, which may temper expectations of RBA rate hikes in the future, despite expectations of a rate hike next week. That rate hike next week is already priced in, and if you get any bad numbers out of the Australian economy next week, with retail sales due and also GDP data, that could help cap the Aussie as well. So the gains we've already seen and the inability to take out 95 could point to a near-term top. Similarly, Kiwi is much lower from the 82.15 highs we've seen this week, and it dipped under the 80s today with the same worries about funding costs, with local banks there raising their mortgage rates because of funding, even though the RBNZ is not raising rates. And that could show that you've got the contagion effect going to dollar block currencies. To that end, because Aussie and Kiwi look like they've reached a highs, it could also flow through to the Canada, and we may have seen a base on dollar CAD around 97. Finally, there's also talk about a possible commodities bubble, that the gains we've seen both in the CRB to record highs, to oil to record highs, and gold to record highs may have a huge reversal, particularly as credit gets tight, and you can see the commodities come off that would weigh on all three of those dollar block currencies.
Okay, Rhonda, before we wrap it up for today's interview, as we head into the month of March, we do have key central bank meetings, as you mentioned earlier. This means we have the ECB, BOE, as well as the FOMC in mid-March. So if you could give us your rate outlook for the central banks at this moment in time and how this affects the respective currencies in the long term.
Well, I think the ECB, because they've been so stubborn about their inflation concerns, I still think they're going to keep rates steady. They've made a point of saying at the last meetings they had no intention of lowering or raising rates, and inflation is their predominant concern. So we don't see anything from them. The BOE, we are getting some concerns about inflation, and certainly some of the members of the Monetary Policy Committee are worried about inflation and see some of the current credit woes as restricted more to the financial markets and elsewhere. But I think we've had enough more bad data that will underpin expectations of a 25 basis point rate cut. As for the FOMC, they have been so negative. We've had Bernanke yesterday warn the market about possible bank failures. Similar concerns were just voiced this afternoon by Lockhart about community banks. So that is raising expectations and is priced into Fed fund futures that we could see a 75 basis point rate cut by the Fed at the next meeting. To that end, of course, everyone's focusing on the fact that U.S. 3-month LIBOR rates are now below Swiss rates, and cash rates are now set to go below Swiss rates, which will see the dollar continue to weaken. And the new trend emerging and reported in the Nikkei this week that the dollar is being used now as a funding currency for carry trades because yields are so low.
Okay, Rhonda, as always, thank you very much for insight and analysis, and have a great weekend. This has been your Forex Market Buzz with Rhonda Staskow from Thomson Financial. I'm Remy Hokie. Join us later this afternoon for PM Exchange right here on ForexTV.com.